Given the higher interest rates that we've experienced over the past few years, some investors are tilted towards cash savings for the better returns that they are providing, with a lot of investors choosing money market funds as an alternative way of taking advantage of those rate hikes. Money market funds are designed to be that safe haven to put your cash in the shorter term, providing immediate access with higher interest rates than easy access cash savings. So in today's video, I take a look at whether money market funds are safe and whether you are making a good choice to invest in one of them. A money market fund groups securities together in similar ways to equity and bond funds, and all the constituent securities in money market funds are short dated. This means that they all have very short durations before they mature and are repaid to investors. These securities are ways in which governments, corporations and financials borrow money to meet their short-term financial obligations, and such entities may use these instruments rather than taking out a loan as a cheaper way of raising capital. In the UK, money market funds generally consist of short-dated government bonds, also known as gilts. These are issued by the UK government as a way of raising capital to fund the gap between tax revenues and government expenditure. Certificates of deposits or time deposits, which are issued by banks and are similar to short-term fixed-rate deals. And commercial papers, which are unsecured, short-term debt securities issued by corporations, often financials such as banks or insurance companies, to finance short-term liabilities with a specific amount repayable on a specific date. Debt instruments, including those short-term securities found in money market funds, are given credit ratings according to their credit quality by Standard & Poor's, Fitch and Moody's, the three credit agencies. Each has its own grading system, but all will define whether that security is investment grade or non-investment grade. If it's investment grade, it means that it's good quality, and obviously not so good quality if it's non-investment grade. And a non-investment grade bond would also be known as a high yield bond or junk bond. And it's fair to say that no matter what agency you're using to grade the quality, the more A's the better, and less B's mean that it's likely to be non-investment grade and of lesser quality. Using the Vanguard Sterling short money market funds for illustration purposes in this video, you can see that all of its securities have good credit quality, and those found in UK money market funds are generally of good quality, meaning that the issuer is generally reputable and highly unlikely to default on repaying what they owe to the fund or the investors. The UK benchmark for money market funds is the Sterling Overnight Index Average Rate, and this is known as SONIA, and this sets the rates in which banks borrow to each other overnight. So the interest rate or yield that you get on your money market fund closely follows the SONIA rate. This rate is often better than the rate that you would get with cash savings, and is one of the reasons why investors often choose money market funds over cash savings accounts. And the rate or yield that you get with money market funds is often better than cash savings because banks don't always pass on the full SONIA rate to their customers. The SONIA rate is influenced by any Bank of England decision on interest rates, but the actual value of the investments within a money market fund do not change. It's only the interest rate or yield that varies in line with the SONIA benchmark. So let's look at some of the good things about money market funds. So as already mentioned, they potentially offer a higher yield or interest rate than you would get with cash savings. They provide a good, flexible, short-term home for your uninvested cash. They are similar to easy access savings in that they are liquid and you can get access to your funds straight away. They are a great way to hold uninvested funds on your investment platform for the flexibility that they provide in being easily divertible into and out of investments, without the bureaucracy of having to transfer between providers, but while still providing some sort of cash return. They can provide your portfolio with diversity and help reduce overall price volatility. Investors often mix together assets of different classes to help reduce that price volatility, as asset prices often move in different directions to each other, helping to reduce large price falls or rises. With interest rates higher at present, money market funds could provide better short-term returns than the more volatile stocks and equities. If you are risk averse, money market funds could provide a better alternative to equities or bonds, to provide a very smooth investing journey with very little volatility, but also lower returns. Money market funds can provide diversity within themselves. If one of the security issuer defaults, this should have little impact on the fund overall. And they are short-dated, so they're not susceptible to duration risk. Short-dated securities in money market funds generally provide lower returns than longer-dated bonds or equities, because of their shorter durations, have lesser volatility and are more cash-like. Duration risk is where you own a bond which is paying you a regular fixed interest rate or coupon that, unlike a short-dated security, has years to run before it matures. During that time, a lot of things could happen to influence the value of the bond itself. And one of the main things that could happen is that interest rates could change. And if interest rates rise, the fixed rate offered by your existing bond would be lower than the new ones on the market, making your existing bond less desirable and causing it to lose value to make up for this. As a guide, for every 1% rise in interest rates, you will lose about 1% on every year that your bond has left to run. So if there are 10 years left until bond redemption, the value of that bond would drop by about 10%. Unless you hold it to redemption, of course, where you would get the full value of the bond back, as was agreed when the bond was first issued. Obviously, this works both ways, and a fall of 1% in interest rates would increase the value of your bond the other way. And it is this volatility that you get with longer duration bonds that help a bond provide better returns over time than a money market fund. As there is very little or no duration risk with the short-dated securities which are within money market funds, the value of those actual securities and therefore the fund will never change. It's only the yield that changes in line with interest rates, meaning that you will get back the full amount of your investments no matter when you decide to sell. And moving on to some of the negative points about money market funds, the first being that they don't have FSCS protection. The FSCS scheme is government backed and protects you against the failure of a provider, but not against a poorly performing investment that a money market fund could be. In the unlikely event of your fund going bust, you would have to hope that the government would step in to prevent a financial crisis, as it would not be required to where FSCS protection is not applicable. Money market funds provide you with lower returns than bonds or equities in the longer term. You could lose purchasing power if you invest in a money market fund for too long. Just like cash, they would struggle to keep pace with the cost of living in the longer term. There will be additional costs like OCFs and platform fees that you wouldn't have with cash savings. The OCF, or ongoing charge figure, is the annual fund administration fee. In the Vanguard Sterling short-term money market fund that we've mentioned, there is an OCF of 0.12%, and total costs are in the region of 0.27% once you factor in Vanguard's platform fees. The point I make here though is that no matter what money market fund you choose, it will be influenced by fees in some shape or form, and should be taken into account when comparing rates with cash savings, if all you are after is the best savings rate. Are we currently experiencing a bubble? Are interest rates a tipping point and about to fall rapidly? If so, money market fund yields will very quickly start to provide lower returns to investors and be less successful in helping to fulfill longer term objectives. And could a bursting bubble cause liquidity risk if interest rates fall rapidly? If interest rates were to fall rapidly, investors would look to put their money elsewhere, possibly into equities, which are likely to gain momentum if interest rates drop. As money is pulled out of money market funds, the fund manager would have to sell assets to meet the redemption request of investors. In extreme circumstances, with rapidly falling interest rates, you may get liquidity issues due to that high redemption demand, and you could even see funds getting gated, with there being delays in redemptions to investors. I am not saying that investors would lose money here, or that this is very likely to happen. Remember that the value of securities in money market funds stays the same, it's only that yield that changes. And the gating period, if any were to happen, would be short-lived given the short-dated nature of the securities within the fund. If you look at the Vanguard fund, at present, the average security is due to mature in 27 days. So the fund manager would soon be able to sell maturing assets to raise the cash to pay back investors, but there might be a short delay. There may be a credit risk that the issuer of a financial asset held within the fund may not pay income or repay capital to the fund when due. This in turn could cause the fund as a whole to fall in value, and for investors to want to redeem their cash. We spoke earlier about the types of securities that are contained within a money market fund, and commercial papers, although low risk, are the riskier of all those short-dated securities. On September the 8th, 2008, the Lehman Brothers, the fourth biggest investment bank in the US, filed for bankruptcy as a result of the subprime mortgage crisis, and the Lehman Brothers had issued commercial papers that were contained in money market funds. They defaulted, causing those fund values to decrease. This caused mass panic in the financial markets as money market funds became gated as investors tried to pull their money out. One very large US fund called the Reserve Primary Fund had purchased a significant amount of Lehman papers, which made up approximately 1.2% of the fund. Given the subsequent loss of value in the fund and consequent panic, this fund was eventually liquidated. And this panic caused collateral damage, with a lot of other financial institutions teetering on the brink of collapse. However, the US government did intervene in this case, and US investors did get the overwhelming majority of money returned to them, although in some cases it took a few years. And the chances of anything happening again like this are very low. Since the 2008 crisis, banks have stricter rules and regulations to ensure stronger financial balance sheets and to force them to keep more safe capital on their books. And this is measured by the CET1 ratio. Also, the diversity that money market funds provide means that, unless the financial entity in question was massive, it would need a more synchronized set of issuer defaults to cause another crisis. And even then, there's a good chance that the Bank of England will step in to shore up the relevant fund. So to answer the questions that I raised at the beginning of this video as to whether money market funds are safe and whether you are making a good choice to invest in one of them, yes, in my opinion, they are safe, with very little chance of the 2008 financial crisis being repeated, and with them being a potentially good safe haven for your money, especially at present in 2024, with those higher interest rates to give you a reasonable return in the shorter term. And that phrase shorter term is the key to the second part of the question, in whether you are making a good choice to invest in one of them. Obviously, everyone has their own individual circumstances with different financial objectives. But if you have long-term objectives, like saving for your retirement, then you will find that keeping your funds in a money market fund for too long could severely restrict successful future financial outcomes, as money market funds will underperform equities and even bonds in the longer term, and potentially by a lot. The big risk with money market funds is that you take too cautious a position and hold on for them for too long, or try to time the financial markets that are almost impossible to time. If so, you will miss out being in the market, or will not be in the market consistently to take full advantage of the long-term effects that compounding will provide for your investments. And this could hurt you financially in later years. If you want some ideas to help you with your research on what equity funds might help you to build wealth in the long term, then the next video will go through 7 Vanguard funds that might be suitable for you. Thanks very much for watching.